All right. Hi, everyone, and welcome. I'm Amy Gray, she, her, Associate Director of Climate Finance here at Stand.earth, and I'm really excited to welcome you to the launch of the Climate Safe Retirement Funds campaign. Whether you're here as a worker, an organizer, a retiree, or someone who's just starting to think about your retirement savings, this space is definitely for you. Here's the bottom line. Our retirement plans hold trillions of dollars, and many of those funds are currently tied up in volatile and high risk fossil fuel investments. That includes oil and gas and coal companies whose long term financial performance is threatened by the accelerating global transition to cleaner, safer energy. This isn't just a climate issue, friends. This is a matter of financial security and fiduciary responsibility. We're here to help people like you to take the first step in asking a really simple question. What is my retirement plan actually invested in? And do I have a safer, more responsible option? Before we dive in, we're going to go to the next slide and I'm going to introduce our fabulous speakers for today. I wanted to take a moment and just thank them for joining us for this launch event. We're so grateful for their leadership and the very deep experience they each bring to this work. First up, we're honored to be joined by Breene Murphy at Carbon Collective, an investment advisory firm specializing in climate safe, fiduciary aligned portfolios. Breene is an expert in sustainable finance and brings a clear, accessible lens to the question that many of us have: what's actually in my 401k and what can I do about it? He'll walk us through how these plans are structured, what risks those investments pose, and how climate safe investing options can support both strong returns and long-term security. Carbon Collective manages the retirement accounts of all U.S. Stand staff. We are so pleased to be able to offer fossil-free climate-safe investments in a well-rounded portfolio for our staff. Following Breene, we get to hear from the amazing Nancy Treviño from Stop the Money Pipeline, a powerful coalition working to hold the financial sector accountable for its role in the climate crisis. Nancy is a seasoned organizer with a very strong background in labor justice, movement building, and asset manager campaigning. She'll be talking about how Wall Street and major asset managers like Vanguard shape the way our retirement funds are invested and why it's so important for unions, workers, and everyday people like us to take action. She'll also speak to the significance of this fight for working class solidarity and financial justice. Please join me in welcoming Nancy and Breene. Thank you so much for being here and for everything you do. Next slide. So, welcome to the campaign launch. You're saying, what is this campaign? What is going on here? The Climate Safe Retirement Funds campaign is about helping people, workers, retirees, and plan participants take individual action to push for better, safer investing options. We're focused on three things, friends: transparency, accountability, and access to climate safe options. You have the right to know what your retirement plan is invested in. Fiduciaries and plan providers must act in your best financial interest, and that includes properly accounting for climate risk and climate-related financial risk. If your plan doesn't currently offer an investment option that accounts for these risks, don't worry, we believe you should be able to request one, and we will help you do that. We're not just asking asset managers to follow suit. We're organizing participants to assert their rights under ERISA and have access to your plan and what it's invested in. This campaign is about reclaiming agency over our financial futures. Next slide. So why are we here? Oh, we believe it's important for employers and retirement plan administrators to give workers the option to choose climate safe retirement plans. And through this, workers will regain control over their savings, ensure their investments are safe from climate related financial risks, and retire with dignity, knowing future generations will inherit a better world. Next slide. All right. So, how did we get here? Well, when individuals start asking questions and requesting climate safe investment options, it sends a clear signal to the market. How are we going to accomplish this? Collective action, friends. Small actions, big change. These actions help drive market change by pushing fund managers and corporations to really think about how capital is allocated and adopt more sustainable practices. As more people get involved, that momentum can also influence policy, building pressure for greater transparency, accountability, and regulation that supports responsible investing. And most importantly, the campaign provides the small personal actions that add up. When enough of us speak out, we create a ripple effect that can reshape entire industries and bring us closer to a more secure, climate safe future. Next slide. What you're seeing here is just a snapshot of how massive the US retirement system is. These aren't just abstract figures, these are collective financial futures of millions of working people. And with such an enormous amount of money at play, where it's invested has a major impact. A huge portion of those assets, conservatively estimated in the hundreds of billions, are still tied up in fossil fuels. That's not only a risk to our climate, but also to the long term stability of these funds. These numbers show us the scale of the opportunity, even if it's a small percentage of this capital is redirected towards more sustainable climate safe investments, it could shift entire markets and protect both our savings and our planet, friends. All right. Now we are going to pass it over to the amazing Breene, and Breene is going to talk to us about all of this.
All right, here we go. I'm just impressed that I unmuted myself before I stopped or started talking. So that's a really good start. I want to make sure my slides are up and visible. All right, I think. All right, there we are. Living life. Okay, so before I really dive in, the thing I wanted to say is thank you so much to Stand.earth Climate Safe Retirements for bringing me here. Um, I, I I think this is a really interesting topic and the right time. I even wrote an article with Amy and the Stand.earth team about why this is like actually a pretty good time to bring the divestment movement into retirement plans. And we're going to go into that today. The first thing I'm going to say, though, is as much as many of the people on this call are here for ethical reasons, right? We want a livable planet. We think that's important. I'm going to be really diving into the financial reasons because that is the landscape under which decisions can be made in the legal framework we have in the United States. So, with that, can I get next slide? There we go. Our big disclaimer to all of this is there's two big ones. First, this is all educational, and what that means is I don't know your exact 401k plan. You have not hired me to give you financial advice, so it's educational. Thing number two is past performance does not guarantee future results. We don't know the future, and that is both good and bad. But I'll go into that. All right, next slide. All right. Deeply nerdy agenda. I just want to call it like it is. I'm wearing a pink Hawaiian shirt. I'm excited about this. This is not something a normal person gets super excited about, but I think it is really exciting. I have two parts with our conclusions at the end. Target date funds. I think they're one of the coolest innovations in the financial world in the last 30 years. I want to talk about why they're so important to helping divest 401ks, and then why a climate smart target date series makes fiduciary sense. This is helping understand where the flows are going and reduce people's anxieties and maybe even get a plan sponsor, which is the nerdy little nickname for the person that runs your retirement plan, to be excited. All right, next slide. All right, part one, why this is really, 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 really hard without fossil fuel free target date funds. Next slide. Okay, we are very fortunate to be in this time in which there are more funds being added to more plans, even at the largest level. For example, Google has a Parnassus fossil free fund. This Parnassus mid cap fund is something I've seen in a lot of environmental nonprofits plans, right? But how much of a Parnassus mid cap fund should be in, let's say, a random 42-year-old who has a 7 and a 4-year-old, cares about climate change and wears pink Hawaiian shirts? Like, how much should be there? It's got zero fossil fuels. That's kind of interesting. It's got strong historic performance. But what percent of that 401k should be in this fund? All right, next slide. Tough answer. Is it 5%? Is it 10%? Is it 50%? Is it 100%? I bet a lot of people on this call wouldn't have that answer. And when you look at like what would this fund play a role in a traditionally diversified portfolio, a mid cap fund is going to be like 5 to 10, 5 to 15, maybe 20% of a equity holdings, right? Which is all the stock holdings you have. Does not include the bond holdings you have, which as you get older, bonds become a more prominent role. So right there, it just is really unclear. Next slide. And it's what makes it hard is there's so few people that are confident in finances. This is based on Pew Research. I actually think this is aggressive. I don't think I know 20% of the people that are really confident in their finances in every category. I don't know if 20% of people could build a portfolio. So this is what the research is there, and it's just people don't know what to do with it. This is a broad problem in the United States. Next slide. And so this gets into the cool innovation that I think it has been wildly underappreciated in financial services, which is a target date fund. So if you look at this, you see four colors. You'll see this light green, that's US stocks. You'll see a dark green, that's international stocks. You'll see this burnt orange yellow thing. Forgive my ability to classify that color. And then you'll see like a darker yellow, like a kind of a gold. Those are all like those last two are in bonds, right? So you can see on the bottom, it shows where you are in a career. And in the phase in an early career, the thing that you know is you are probably very far from retirement. Because so it's starting to answer the most important question in investing. When do I need the money? And you don't need it for a long time, so you can have a lot of money in stocks. And then as you get into this transition, this is where I am. I'm 42 years old. You can see it denotes it at 40. It's going to get gradually more conservative as I get closer to retirement. This will remove the risk so that if a 2008 were to happen again, I don't know if you know this, but in 2008, the bond market actually did very well, while the stock market did terrible. And so it was able to buffer people's investments had you had a diversified portfolio. So it's this really fascinating thing that allows someone with one click to get a good investment portfolio. All right, next slide. And this has come at a time in which there's been legislation to keep Americans on track for retirement. In 2016 or 2006, there was the Pension Protection Act. It was based on a narrower group of Americans, but a third of eligible workers were not using their retirement plans. So they added the ability to have automatic enrollment, which means they make it so you're automatically contributing money from your paycheck to your 401k, and you will not be sued. They also added the ability to have a qualified default investment alternative. That means like when you sign up at your employer, your money just goes into something. 2022, it upped those. There's still not enough people able to retire. It gave some benefits to small companies, tax credits. It made the automatic enrollment necessary for new plans because it's like this is not just possible, but this is what needs to be the default. And they added automatic escalation, so it's like increasing amounts that you will like contribute to your 401k to increase the likelihood that you will be on track for retirement. So next slide. The reason why that's important is we're getting this financial innovation of target date funds that can be a default investment at a time when legislation is adding automatic enrollment, a default investment, so people don't even have to choose. And so they are becoming very popular. So by 2027, target date funds will capture roughly 66% of all 401k contributions. This is just money that's being added in that time frame, and 46% of all total 401k assets in target date funds. Because people would have had their 401ks for a long time, so it's going to be a lower amount. That's a pretty amazing statistic to show how popular it is. So when we hear of a lot of people that are like, let's divest at our 401k, it's really hard to do at every company I've ever been a part of that is not one of our clients because they don't have the target date funds and they don't have that default set up. And so it becomes really hard if you have one fund on a lineup, if it's all equities, or it just doesn't set up. So next slide. And so the time available to do the research and the financial literacy ends up outweighing individuals' best interest. And that's the problem. So, next slide. And this means target date series, even the ones that have a D rating on fossilfreefunds.org, as you sow, they are going to be very popular in some of your favorite environmental nonprofits, some of like the most sustainable brands you know of. That is why it is. I've only seen me being a nerd. I'm just going to tell you this. Like I tried to like write Bill McKibben because I was like, if anybody has seen someone else that is able to do a fossil fuel free default option, he would have. I've never seen I, his college, Middlebury, still has fossil fuel free or fossil fuel default options, right? So they haven't even done it there at Middlebury. Um, so it's very common. It's just why this is so hard to do without defaults. All right, next slide. So is it possible to change the status quo though? Yes. 46% of Carbon Collective's 401k assets are in our fossil fuel free target date fund series. All right, so we know it's possible to do it on a larger scale. Keep going. You're right, Wojtek. I love you. Part two. So, is it possible is one thing, but the second thing is it legal? Is it a good idea, right? Because one of the most common things that I hear from employees that have gone and asked their HR leaders, hey, can we get more sustainable options? Is no, we have to protect our fiduciary interest. So, I'm actually going to make an argument for why they can be included and why it makes a plan fiduciary even better, like stronger. So, next slide. There it is. All right, next slide. All right. I want to define the parameters really closely. This is literally taken from the Department of Labor's definition of fiduciary duty for plan sponsors, which are the people that are responsible for the retirement plan at at a company or nonprofit. So key number one is to make all decisions solely for the interest of participants, which is a very, I think, annoying term for employees. I don't choose these terms. I'm sorry about that. And then the number one thing is diversify to minimize the risk of large losses. And the second thing is document that you follow the plan documents. And again, make sure you put people's interests first. Next slide. Okay, we've just said put people's interests first. But there are thousands of people who are asking for this. So what is that stopgap? All right, next slide. And when you go in to diversify the risk of large losses, we start to look at the performance, just simple performance. This is from the S&P 500, S&P Global's website. It was from last week. I wanted to make sure I had accurate numbers. I didn't have them up to the minute. That's like I'll have to live with that. S&P 500 energy, it's like roughly flat over the last year, even with Donald Trump coming into the office and his so-called like whatever it is, like make oil great again. I've seen some stuff like that, right? Even with all that, politics and markets don't always like coincide as much as you would think. 3 year, it's slightly trailing the S&P 500, not bad. The 5 year is really good. It had two really good years, 2021 and 2022. You might remember this is when Russia invaded Ukraine. We had boycotts against Russia and Russian oil. So you have a decreased supply of oil with the same demand. And so you had a big pop in that year. I don't see that as like relevant to the market, but like long term. And then 10 years back to a pretty paltry 2.4% return. Compared to the S&P 500, it is largely underperformed in three of four time windows. And in two of those windows, really pretty significantly, the most recent one and the longest time period. All right, next slide. And it's important to then go and look ahead. And even in the high growth scenarios, this is a slide from Researchers for the Future. And I've always found that this slide, like, it shows how big the different projections are for global oil demand in 2050. And the thing I see is even in the most high growth scenarios, oil demand is not projected to grow much, right? Like that is not a good sign for your investments that you're looking to get, 5, 6, 7, 10, 15% like annual return on, right? Like that is not a great place to say, oh, this thing that's at, I think it's at 175 QBTUs. And it's going to like just like in the highest scenario, it's going to over 200, right? Like that is not meaningful growth over 25 years. And it could suffer a big loss in demand. Um, but any scenario you're looking at, none of it is like, oh my gosh, this is going like everyone's going to use way more of this. All right, next slide. So what we could be talking about is climate change could introduce large losses to unprepared portfolios. Rising sea levels, rising insurance premiums. That's something as a Southern Californian I'm really sensitive to with the LA wildfires. Legislative change. There's the falling demand for fossil fuels. Um, you're seeing rising wildfire risks. Again, greater geopolitical instability, longer, hotter droughts, faster, greater floods. There's also the opposite side of this. Wojtek, if you can give me another slide. You have the opportunities. We're seeing exponential adoption of solar, right? Like even if the Trump administration, makes it permitting easy for utilities, like north of 80% of what is slated to come on board is renewable. You have solar, batteries. Batteries are taking over, especially in Texas. EVs, those are becoming a high demand. I mean, you're seeing innovation everywhere. BYD in China just announced that they have a 5-minute charger to get 240 miles per charge. This is a big deal. Expanding the electrical grid. Everyone wants that. Critical minerals, hydrogen fuels, EV chargers, energy efficiency in buildings. So there's all this stuff that is like exponentially being adopted, and that's the kind of thing you would not want to miss out on in your portfolio. All right, next slide. And so the answer has been to include fund options that account for climate risk and opportunity. Again, we're trying to make sure that we diversify against the risk of large losses. We don't want to take away people's investments, right? They may like those passive options. We don't, you saw that time periods. There may be time periods in which the certain investments perform better, but we want to add options. Next slide. And this is where you're like, no, 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 wait, is that legal? So next slide. There's been two large cases that have come up, but I want to talk about one that we find the most influential. So in 2021, there was a hospital that was sued because they had actively managed funds. If you're a finance nerd, you would have long heard of Jack Bogle and Vanguard, and kind of what they have shown over time is that passive investing outperforms active. And so this person was very upset that they were defaulted into actively managed funds that underperformed what would have been passive options. And the judge ruled that there is no mandated investment philosophy. You can have multiple ones in a plan, and they should not be compared against each other. What you should have is options to both. And because in this plan, they had options to the low fee passive options, they were found that they had run a good 401k plan. So we're using that ability to use multiple investment philosophies to say we can add a climate smart target date as the default. Add it and make it the default. Next slide. I want to go into the recent rulings. At Carbon Collective, we've read them. I don't think that there's anything. They sound really weird, but I don't think there's anything that is actually that strange. Which is, both cases double down on a plan sponsor's duty to put the interests of participants first. Next slide. There's Spence versus AA, and they were found guilty in breach of duty of loyalty, but not prudence. Prudence is, are they looking at the investments in the plan? And what they found that it was American Airlines had a unique relationship with BlackRock because BlackRock owned 5% of American Airlines and had lent them millions of dollars. And so there was this like uh, blending of corporate interests versus plan participant interests. And there was some proxy voting that BlackRock was doing that could have hurt the airline industry. And so it's a stretch as far as rulings go, and we still don't know how much they're going to have to pay. But that's not a unique that is a very unique scenario. At the same time, also in a Texas court, there's a federal DOL ruling by Judge Matthew Kacsmaryk, and he basically said that the Biden ESG DOL rule can stand because the 2022 rule does not permit a fiduciary to act for other interests than the planned beneficiaries or for other purposes than the beneficiary's financial benefit. What he's saying is it doesn't change the rules of the game. It just means that you can use this investment philosophy. So that is what we're seeing. It's like everything we've built our investment philosophy on and our approach to fiduciary responsibility is saying is being was under like these rules, and none of it we feel like is a challenge. Next slide. So again, like how we do it at Carbon Collective is we include multiple investment philosophies in every 401k plan and select the best performing funds per investment philosophy. Next slide. And when we go and onboard a team, we try to make sure that they are not getting any sort of like ethical decision. And we are telling them very specifically, we're not forcing you to invest any one way, but we will give you the argumentation why any of these could outperform the others on a purely financial level. So we'll talk about why passive might outperform. We'll talk about why ESG might outperform. We'll talk about what climate might outperform, right? Now the decision that we get to make, and this is where like that loyalty thing on the AA versus Spence issues, I think of interest is we try to pick the default using our target date options based on the interests of the employees. Like we don't have our climate smart target dates as the default for every plan. Most of them, because the companies that hire us don't usually hire us to have them as a secondary option. But that's how we've done it. Next slide. So here's what a fund list looks like. You see the options in climate. I know a lot of people also like Alex Gladstein's at Sphere. That's on there. You can choose that. We actually got a big notice recently. Natixis their sustainable future funds are going to be closing down, so we'll be changing that. But we look at what are the best performing funds with target date funds. So TIAA Craft, they just actually rebranded to Nuveen. They have a life cycle. They have performed a little bit better than the Vanguard ones. The Fidelity S&P 500 fund, for some reason, has performed like a few basis points better than the Vanguard S&P 500 fund. So we're showing the absolute best performance by investment philosophy and by asset class. And so that has been where we are trying to elevate the fiduciary responsibility of a plan sponsor. So they are like nails it when they're able to address any of their employees' best interests. All right, next slide. And this goes into like investment performance. We try to show this so that people can get like what it looks like because these are different investment philosophies. And you can see over 1 year, Carbon Collective, our climate smart ones, it was 14.76% returns last year. Next slide. And so it was the best option. It wasn't the best option in the 3 years, because of that 2022 year and 2023. Those are tougher years for us. Go to 5 year, but it did outperform over 5 years. So we are not saying that a climate smart or climate investment philosophy is going to outperform over every period. That is not what we're saying. But we are saying it does outperform over some periods. And so as a result, and since we don't know when an employee is going to be there over what time period, we do think it does give them options to minimize the risk of large losses. All right, next slide. So that's how we built our Better Together 401k program. These are the types of people we help. And then last slide. We do 403Bs too. We do it with like what are called managed accounts to help it. Um, Ask me questions. You can find me on LinkedIn. You can email me. I love doing this. I think it's an incredibly fascinating topic. I feel very grateful. I get to help people like Amy at Stand.earth, and so that's my whole shebang.
Thank you so much for all of that. And we know, folks, that this was a lot of information and we came
Totally.
at you with a ton of stuff. So we will share PDF versions of the slide deck so that you can read the information. We will share this recording and then we will have our toolkit. Everything will live in those places so that folks on this call can access that. So we're going to take a quick pause. I'm looking at our time. So we have time. We're going to take just a couple of questions for Breene. Um,
Mhm.
and let's see here. I'm going to tap my background tech support. Cassie, do we have any questions that you think are important to pull, or I can pull a couple I see some in the Q&A that,
I can start answering them, and it can be fairly quickly.
yeah, let's go.
Susan Mason, are these the company that employs you is a fiduciary to you and your best interests on your 401(k) plan. So yes, if that's how you defined it. Um, um, Amy Brooks, I'm curious why it's so difficult for financial investors to stop investing in fossil fuel when it represents such a small share of overall investments. This is largely due to um, modern portfolio theory and the which is like I know this wasn't the answer you were looking for, but it basically defines how to allocate investments and that you want investments across all different sectors, such that you can mitigate performance in the ups and downs. So that's why. So classical asset allocation is like not structured that way. We had to jump through hoops to be able to do this on 401(k). If you really want, email me. I'll walk you through all the weird nerdiness that we did to do it. Um,
Here's another
but-
good one. I see a really good one for you. Okay, so here's a good one. From Mariana. I work as an independent contractor and
oh
have
yeah,
CP IRA. That one on the uh
I'm so
big
glad you have a SEP. By the way, SEP IRAs are really valuable if you are an independent contractor because they have higher contribution limits. And like Marianne, we have SEPs if you want to reach out to me. Um, you like so you said there should be penalized if you do that. Um, I think I don't know. I like so SEPs are not something I do every day. So, but what I do know about SEPs is the penalty that is my understanding on it is that it is if you take out your investments before and move them into like a brokerage account, for example, before you're 59 and a half, and there's a 10% penalty for that. I'll let me double check, but I do not believe there's any penalties for changing SEP providers. Like you can move your SEP from one SEP to another and I believe to be fine. If you want, you can reach out to me. I can answer. I'll do research and answer that
and
question.
I shot my email over to Mariana. All right, one more question and then we are on to Nancy.
Oh, I want to do the target date funds one
Okay,
because
do
there's
that
a
one.
non-absentee. I just think this is so important. The most important question in investing is when do I need the money? If you're young on this call, you might not need the money from your retirement investments until 2060. Right? If you're older on this call, you might need it in 2030. Those are different time periods under which you might have to manage risk differently. So if you're needing the money in 5 years, you might want to have more bonds, which are basically loans. And you know your loans, you pay mortgage, you pay the same amount every month. It can be really valuable. So you have like a larger portion like of your investments in bonds. Stocks are you're buying ownership stakes, which you're basically going for appreciation and dividends, and those vary wildly. So I mean, in good ways most of the time, but also in bad ways. So target date funds allow someone to answer the most important question and build a portfolio that gets gradually more conservative as you get closer to that, retirement date. They're amazing.
That was a good question. That was a good, awesome answer too. Thank you, Breene, so much. And I just want to reiterate what we put in the chat, which is that we are pulling all of the questions from the Q&A into a Google Doc, and we are turning that into an FAQ doc for everyone that attended today and will continue to attend our events. So get your questions in, and we will be sure to answer those in the FAQ doc. And now we're honored to have Nancy Treviño from Stop the Money Pipeline. Nancy brings deep experience in union organizing and climate finance campaigns, and she'll speak about the power of organizing fund participants, the role of major asset managers, and why this fight is so important for economic justice and working class people everywhere. Welcome to my very good friend, Nancy.
Thanks so much. Breen, thanks. That was awesome. I know that was just like a bunch of learning on my part too. So appreciate those. And I'll definitely have follow-up questions for you. And Amy, thanks for bringing me along for this launch. As Amy said, I play a role in organizing around asset manager accountability. And the focus of like my intervention today will be on Vanguard. And so Breen brought up some of these money managers, right? These asset managers who manage these funds, including your retirement savings. So some of you here today may be Vanguard clients or BlackRock clients. And so some of the questions that I'll try to answer at, my best capacity are, what their role is in retirement investing and fossil fuel financing. And Bree gave us a really good landscape analysis of their role in fossil fuel financing. So I'll zero in on Vanguard, but I'd first just want to lay out the groundwork of who these entities are, right? They're the biggest investors globally, BlackRock being the largest asset manager in the world. They manage $11.6 trillion in assets, 431 billion in fossil fuels as of last year, making them the second largest investor in fossil fuels in the world. And Vanguard is the second largest asset manager in the world that manages 9 trillion, that has $9 trillion in assets under management. And 444 billion of those funds are invested in fossil fuels as of last year, making them the number one top investors in fossil fuels, and the focus of a campaign I've been a part of over the last year. Next slide, please. And it was, as Amy mentioned at the very outset of this presentation, and I just want to reiterate again, is the total U.S. retirement assets, right, are marked to be $40 trillion. Of those, 29 trillion in assets are with private retirement funds. And 870 billion of those are invested in or exposed to fossil fuels. So this is just, someone asked Bree in the questions regarding, why is it so hard for these asset managers to just move away from these investments, given that it's such a small amount, which is, something we've been asking ourselves for quite some time now. But we know there's a lot of invested interest in these industries. Next slide. So I want to focus on Vanguard. The Vanguard SOS campaign was launched in 2021. I've been a part of the campaign over the last year. And I just want to give kind of like a state of play of where we are in this moment. Vanguard is a private company, not very transparent. It's a hard target on campaigners like myself, who are targeting climate, you know, financial players here. Vanguard named a CEO, Salim Ramji, last year, who started his tenure with the company nearly a year ago. He was a first outside hire who comes from BlackRock, right? So he knows the industry quite well. It's, a move that Vanguard hadn't done in the past, but kept us cautiously optimistic about what this would mean for their business practices, and they would concede to some of the demands of the campaign. And over the last year of the campaign, we were really focused on several strategies, being right the external pressure since the onset of the campaign through grassroots organizing, campaigning, organizing retail clients like yourselves, and even institutional clients, which I'll get to. Part of what we're hoping to accomplish through the campaign is to get the executives right to take action. And so our focus over the last year was on some of the more movable executives on their board, including their newest CEO. And through the campaigning over the last year, their business practices haven't shifted much. Our cautious optimism is still there. The CEO has been there for a year, but we're iterating on strategy and seeing where we can get some movement. And thus far, our requests to get meetings with the newest CEO have gone unanswered. Next slide. And as we looked at where our campaign was over the last year, we made determinations that we still think it's a great opportunity to continue focusing on the executive of Vanguard, and pursuing the opportunity of organizing workers and individuals to pressure pressure Vanguard and BlackRock and other asset managers to really give people like you who are joining us today and others the ability to choose a climate safe retirement fund. And so part of my intervention today is to focus on how workers got organized in 2024 to make the case to one of the biggest employers in the country, and a big player in tech, Google. Next slide. And so, last year, nearly a year ago, Google workers started applying pressure. A report came out from As You Sow, in partnership with the University of Waterloo, and with our partners at Sunrise Project regarding a landscape analysis of what it meant for people's retirement funds and retirement savings if asset managers like Vanguard, their money managers, kept investing in fossil fuels. And what this report exposed was that Google employees missed out on $1 billion due to their 401k's planned continued investment in fossil fuels. And you can imagine being a Google worker, how this would land for you, knowing that, the work you're doing day to day and those savings you're hoping to enjoy when you retire, are being lost due to bad investments. Next slide. And so Google workers found the opportunity here. They got organized. Breene, showed a slide earlier regarding this headline here that over 1,000 employees organized over the last year to urge the company to divest their 401k's from fossil fuels, given the purely financial impact that Breene so eloquently explained through what they're doing at Carbon Collective, despite the values alignment with not wanting to contribute to climate catastrophe and climate destruction. This is just a bad financial outcome. And so, workers got organized, are urging the company to do right by climate, but also by them, and really protect their long-term investments in their 401k's. Next slide. And so what you'll see on this screenshot as well is, there was a really strategic decision to go after big tech, specifically Google, given just the size of the company, and the billions in dollars that are being invested through their employees' 401k's. And so what you'll see here, designated in red, that this study found that not just Google, but another big one, Microsoft, also, lost nearly $1 billion of potential earnings in that 10-year run. Next slide. And some of this was discussed earlier in the presentation by Breene, so I won't get into it too much. But what I wanted to comment that's relevant to the Vanguard SOS campaign is, through conversations and some meetings and emails that we have gotten through with the Vanguard executives and the leadership there, is that they don't have any fiduciary duty or responsibility on dictating how the corporations that are included in their portfolios should behave, what investments they should make, what their 401k plans should look like. But demonstrated, through Breen's intervention earlier, there are good returns that can come out of fossil free funds, and there are ways for workers to get organized, given studies like the As You Sow study. And that there are options for your retirement funds long term. So as you can see in the graph here, the investments over the long term, if we continue investing in fossil fuels, just won't be so great, right, for the planet and for our pocketbooks long term. So I wanted to make sure that I demonstrated that through this intervention, and that there are options, right? Organizing within your workplace. If you're a retail client, there are options for you to invest in funds that are fossil free. And there are organizations who are doing this, right, within the NGO space. One of our partners in the Vanguard SOS campaign is Earthquaker Action Team, Equate, who has been doing a wonderful job of walking Vanguard clients specifically on how they can move their money outside of a asset manager who is not doing enough to change their business practices to protect the planet, but to also protect people's retirement plans. Next slide. And so with that, I wanted to offer a call to action, a resource for any of you who may be Vanguard clients who are interested in moving your money away from the Vanguards of the world, or exploring other options to apply pressure on Vanguard, organize within your workplace if your employer is an institutional client of Vanguard, that there are ways to hold these entities accountable, and then also make some wise decisions on where your money should be invested. And so Vanguard has monthly webinars on how to move your money out of Vanguard they can walk you through that process, and will be uplifting and amplifying those throughout the months to come as Stop the Money Pipeline. So I'll stop right there. My intervention isn't as long as Breen's, but I did want to walk us through kind of the Vanguard SOS campaign, what workers can do and have the power to do to move the asset managers of the world to give them climate safe retirement funds. Thank you.
Thank you so much, Nancy. That was amazing. And now that we have heard from both Breene and Nancy, we have a well-rounded picture of the retirement fund ecosystem. So that means I can kick off my part describing this campaign to you as well. So the Climate Safe Retirement Funds campaign is about empowering retirement fund plan participants like all of us to take simple, effective action. It starts with learning what your retirement plan is invested in. Then making a request for transparency. That means if you need forms or information, or you can't find what you're invested in, you request that through your plan. And then once you have all that information and you can make a well-informed decision, then you're going to make a request to your plan for a climate safe investment option. And when enough of us make these requests, it sends a strong signal to employers, plan administrators, and the financial industry that we want options that protect our financial future while managing climate risk. It's about collective action driving systemic change. one request at a time. What this campaign is it's about a movement to empower individuals to ask their retirement plans for fossil-free investment options and to push for greater transparency on where our money is going. It's a strategy to hold plans accountable by ensuring that they provide climate-safe options and disclose financial risks tied to fossil fuel investments. This campaign also excitingly, includes some legal strategies, such as ERISA litigation to enforce fiduciary responsibility around climate risk, and some Title VII litigation to establish workers' rights to investment choices based on moral objections. So these are kind of some of this is the facets and like the pillars of this campaign. And what this campaign isn't is this is not just a campaign against asset managers. We're focused on participant action and plan accountability to drive systemic change. And that's why I bring my good friend Nancy with me, who is focused on asset managers, because it is important not only for us as participants to take action and to hold our plans accountable, but it's also important for us as a movement and us, as participants to participate in these campaigns, pressuring asset managers. And so it's not just about ethics. We, of course, being in the movement, it's always about that for us. But really, like this is about financial security. And yes, the ethics and the morals are important to us as a movement, but it's also about protecting the financial security of the working class and ensuring that retirement funds are protected from the financial risks of these investments. And this isn't an isolated effort. We've seen with other market shifts, transparency and pressure from individuals can influence investment trends and reshape the financial system. So, with more transparency, stronger legal accountability, and collective action, we can get our retirement plans to provide climate safe options, helping individuals to take control of their financial future while accelerating the transition to a just climate safe economy. The power lies with plan participants. Like together, we can advocate for better. And so that's what you're doing here. We're going to check this off. We're going to attend this kickoff call. Then you're going to come to an action hour. You're going to research your retirement plans. You're going to make a request, and then you're going to choose your option and invest. And then we're going to celebrate. So on the next slide, I'm just going to run you through some things that are coming up so that you can participate in this. We are really excited. Now it's time to take action. We're launching this today. We're supporting our friends in all of their asset manager campaigns. We have our amazing experts at Carbon Collective. And so now we're going to host some action hours. So you're going to join us on April 3rd and April 9th. You don't have to come to both. It's
I'm
just
coming to both.
You're coming to both. I'm coming to both. But one's during the day and then one's in the evening, so that our working class folks who do have a 9 to 5 and can't jump on a action hour during the day can participate with an evening session. So we have two sessions, April 3rd during the day, April 9th in the evening. We're going to share those registration links. You can also use our toolkit, which we're going to share to ask your retirement plan for transparency and a climate safe investment option. And if you haven't already, you can sign our Workers Deserve Climate Safe Retirement Funds petition, check out our website, and follow us on LinkedIn and Blue Sky. And lastly, please share this campaign with your coworkers, HR reps, or union leadership. It starts with one request. I just want to thank you again to our amazing speakers, Nancy and Breene. And thank you to all of you for showing up today, asking questions, and starting this journey with us. Today was just the beginning. This campaign is going to give people the tools, the knowledge, and the support to take meaningful action, because our retirement savings should be transparent, accountable, and aligned with a secure financial future. And whether you're in a union, a public pension, or a private 401k, you have the right to know what your plan is invested in and to ask for safer, climate conscious options. The financial industry is watching. Change doesn't come from the top. It comes from people like you and me taking bold, informed action. And together, we can start shifting billions towards more secure, responsible investing. This is how we build power from the ground up across workplaces and sectors, one request at a time. And we're taking on a financial financial system that has long operated in the dark and shining a light on what our money is funding and how we change that. So, on behalf of the Climate Safe Retirement Funds campaign and Stand.earth, Stop the Money Pipeline, and Carbon Collective, thank you again for being here, and we can't wait to keep building with you. Have a wonderful day, and we'll see you at the action hours. Bye.